Joining us exclusively now, former Federal Reserve Chairman Alan Greenspan. Mr. Chairman, great to see you, as always. Good morning.
Good morning.
So do you agree with that characterization that the U.S. is in a pretty good spot right now?
I would say in the very short run, because one of the things that I don't think we recognize is that the real GDP change is very largely a function of stock price change. In other words, a 10% increase in stock prices, say the S&P 500, gives you a 1% increase in GDP over a one-quarter lag. So that, in a sense, what we're seeing now is, I think, some improvements, fairly significant improvement in the very short run range of the economy, but I don't think it's going to stay there. I think it's going to begin to fade out because Europe is not doing well, and we still have the problem, which there's very substantial fiscal problems associated with entitlements.
Yeah, I know you've been flagging that for a while. So when you say it's going to fade out, are you talking about the stock market rally or the U.S. economic growth picture, or both?
No, I'm not forecasting the stock market rally. I'm just merely saying that the stock market rally to date has already built in a significant rise in GDP in the current period. And it's a 10-to-1, 10% rise in stock prices is equal to a 1% rise in the real GDP change. So that there's a bit of a stock market aura about the current economy.
So you see it's short-lived. I mean, this is a decade-long expansion now that we are in. Sorry, it's loud here at the New York Stock Exchange. We've got an IPO today, Mr. Chairman. So how much longer do you think the recovery can last now that we're going into past a decade?
Well, I think the real major problem is, over the long run, we've got this very significant continued drain coming from entitlements, which are basically draining capital investment dollar for dollar with any major change in entitlements. And entitlements are going to rise. Why? Because the population is aging. There's no way to reverse that, and the politics of it are awful, as you well know.
Mr. Chairman, got the minutes this week from prior meeting, and over again they talk about the current weakness in the view of many participants being temporary, fading, likely abate. Most participants indicated they did not expect it to persist beyond Q1. Is your view that you would have been in the minority if you were in that meeting?
No, I probably, my basic view is that short run looks reasonably good. Longer run fades very dramatically, in large part because the rest of the world is sinking. And remember, Brexit is having a negative effect on the United States, as well as all those other problems that are in Europe and, in a certain sense, Asia. Aside from East Asia, I was saying, aside from East Asia, the global economy is not doing well.
Yeah, I mean, so do you think that the inverted yield curve ultimately is going to turn out to be a recession indicator here?
I'm a little skeptical about that correlation. I don't use it particularly, and I don't find any real reason to use it, but I don't deny there is some correlation.
National Economic Council Director Larry Kudlow making some comments at an event yesterday in Washington that really stood out to us. He said, interest rates, quote, may never rise again in my lifetime. Do you think that's true?
Say that again?
So Larry Kudlow told people yesterday that he doesn't think interest rates are going to rise again in his life.
Don't hold your breath on that one.
Do you think the next move is going to be a cut or a hike?
Well, forget the Federal Reserve. The real major issue is what's happening to the yield on the 10-year note, or as I like to use it, a very critical variable is the gap between the 30-year Treasury yield and the 5-year note yield. That is a measure of the degree of willingness on the part of corporate management to make investments in the longer run. And it works rather well, and it's a very important indicator of the economic outlook.
Mr. Chairman, leverage loans. Again, the minutes paid some respect to what they said. They said an economic deterioration, if it occurred, might be amplified by significant debt service burdens for many firms. To what degree does that constitute something you're watching on your radar?
Well, I would say that that statement is true whenever the economy weakens. Obviously, a number of firms are in trouble. It's really the same statement. In other words, you say S&P earnings per share and the economic outlook, you're not talking about two different things.
You've been sounding the alarm a few times in this interview about entitlements and the rising debt load. I mean, we got news this week that wasn't encouraging on that front. The deficit is rising faster than expected. It jumped almost $157 billion in March alone. We're looking at a 15% increase from last year. Where does all this go with both parties seemingly advocating more spending?
Well, that's exactly what the key issue is. Deficits per se don't have a political effect, because there's always, if somebody can put in $3 extra million in a particular program, that has no effect. The political impact from deficits occur only as they ultimately generate inflation. Inflation is a toxic, is really the toxic problem with respect to the economy and the markets. I don't see that well, for example, Richard Nixon imposed wage and price controls when the inflation rate was only 4%. And everybody thought that was a terrific idea until they saw the consequences. These deficits, which are programmed, as you know, to get significantly larger, $1 trillion plus, it's only when they spill over into increased money supply, or more exactly, unit money supply, that we begin to see the political impact of inflation in a counterforce. But I'm not surprised at all that the CBO or OMB puts out huge forecasts of the deficit, and nobody seems to mind. Mm-hmm. They will mind when those things get monetized.
Yeah. And finally, Mr. Chairman, do you think that the president is putting the independence of the Federal Reserve at risk if he nominates someone like Stephen Moore to the Board of Governors, not to mention the fact that he constantly bashes Chairman Jay Powell and is calling for an interest rate cut?
Well, just remember, this is not new. I mean, I was in the Fed for almost 2 decades, and I had an awful lot of that. Just remember that every governor takes the oath of maintaining the Constitution of the United States, and that includes the act that generated the Fed in 1913. So if they hit, Open Market Committee just adheres to what they're supposed to be doing and not listen to outside commentary, they're in good shape. There's never been a governor impeached. And I grant you that the president does have a choice every 4 years of changing the head of the Fed, the chairman. But despite general rumor. It's one vote, one person, not one vote for governors and another vote for the chairman, or two votes for the chairman. It doesn't work that way. So I'm not at all concerned about who makes outside remarks, provided the Fed doesn't respond to them.
Thank you for your perspective. Always good to talk to you. Former Federal Reserve Chairman Alan Greenspan.